Gold this year is one of the top performing assets when it comes to investment opportunities. Now, what I mean by that is that if you look at like the S&P 500, let's take a look at how much that has gone up this year. So the S&P 500 using a 12-month chart, yes, this is the entire year in a single candle, is up about 22.6%, which is remarkable. And if we take a look at the NASDAQ, you can see this one is also up pretty good. You're talking about a 21.4% gain. If we take a look at the Dow Jones, you've got the Dow going up about 13.6%. But let's talk about gold. And the reason I say, we should address this is that a lot of times when you turn on financial television, they don't talk about gold very much. Yet silently, this year, gold is up more than the other ones, 33% in a singular year. Now, does this mean, guys, that gold is headed for doom going into 2025? Is this going to be the big, ugly reversal that we never saw coming? Well, I want to take you back in time and show you some other examples of years where gold was actually up 30% and what happened next. Take a look back in 2008 when people were really scared about what was going on in the economy and elections and World War III on the brink of happening, all these things all at once, and it almost sounds a little bit familiar.
We're stuck in a repetition, a loop.
And then look at what happened in the coming years after that. We can see that, again, after that 30% up year, gold went up, well, in the next few years, another 100+%. Now, the reason I bring this up is that gold may look to some like it is overbought, and how could it possibly be going up so much? But remember the underlying fundamental story of gold. Gold goes up over time because they continuously print more fiat currency in the world. As more currency gets printed, it makes sense that the value of gold should go up. It's really just simple math. If you're talking about currency supply increasing, then the value of gold relative to that existing currency supply should go up. So that brings me back to today's price action, where we see the daily chart for gold looking really solid. And this year, gold has really made some people hurt. If you've been on the short side, if you've been fighting this upward move, this is one that has probably taught you some painful lessons. And it takes me back to kind of where I was years and years ago, where I realized when something is trending really well and there's a good fundamental catalyst, such as uncertainty in the Middle East, uncertainty about elections, and central banks around the world lowering their interest rates, aka printing a ton of money, it makes gold look really attractive and actually maybe not so overbought. In fact, perhaps any pullbacks are opportunities to continue this upward trend, as we saw in 2008, where it was up 30%, and then years to come, it was up even more and more than that. So I just want to re-engineer our thought process on this. The question is not whether or not gold is overbought, but if you are bearish, don't look at price action, look at fundamentals. What could change to make gold reverse? What are some of the clues that would change that story? Well, I can think of an obvious one right off the bat. Let's follow the smart money. If we take a look at the COT net positioning, we can still see the story is written in stone here, or perhaps in metal here, because gold is one of the most heavily institutionally owned instruments. Now, this is something we've looked at all year long. If you're not using the Commitment of Traders data, I highly recommend you consider using a tool like ours to track it. Now, because what we can see here is that in terms of the long relative to short contracts owned and held by institutional money, and I'm talking about hedge funds and banks, long positions massively outweigh the short side. And this is really important because, again, smart money has been cashing in big on this big rip to the upside in gold. In fact, it is the biggest position of the on a percentage base or a positional base that they have, just behind the South African rand, which I find interesting. But the point here with gold being so strongly bought by institutional money is that they're on the right side of this trend, and oftentimes that is the case. Oftentimes institutional money rides out a trend and makes a ton of money on it, and people who have been betting against this have been ignoring what institutional money has been doing. In fact, I want to show you something else on the Edge Finder. We built this tool called the Smart Money Indicator, which allows you to track COT report data over time. And in fact, what we can see here is that throughout this year, they've actually been slowly adding long positions. This blue chart, by the way, represents the COT net positioning held by institutional money. And what do we see happening here? We see institutional money accumulating a position alongside the upward trend. If you want to track smart money, stop messing around, right? It's not going to be easily found in the candlestick patterns that you're staring at in your technical charts. It could be found directly in the data from the Commitment of Traders report. We've mapped this out to make it easy to track and follow. And if you don't already have access to the Edge Finder, we'll drop a link here in the description down below where you can sign up for a 30-day trial and try out the tool. If that's something you're interested in, again, use that link down below to apply for that trial and we'll send you some information. But there are other things to consider here beyond just the Commitment of Traders data. Let's keep an eye on inflation data. If inflation continues to cool off, there's a good chance gold continues to rip higher. Why is that? Well, because if inflation cools off, the Fed is expected to reduce borrowing costs or aka cut their interest rates. And if that happens, then more money gets printed into the system and gold goes higher. That's kind of been the story of 2024. And if you've missed it, you're not paying attention to the fundamentals. The fundamentals have been pretty clear here. Falling inflation plus falling interest rates, historically very bullish for gold. So if you're a bear on gold, if you're looking for that reversal, then we need to see stuff like this start to reverse course, inflation to pick up again, and for the Fed to stop talking about cutting rates so much. On a price action basis, you need to start seeing support fail. If you're a bear on gold, the odds are stacked against you right now, right? It has been a very bullish year, and I would actually bet that most likely next year is going to continue to be bullish for gold. That being said, what reverses course? Well, you got to watch the price action as well. We want to make sure that number one, we're watching sentiment and fundamentals. Number two, then we look at price action and see if we're seeing confirmations like failures to hold support levels, retests that are getting sold into, etc. I mentioned it a moment ago, but I cannot emphasize enough how important it is that if you are trying to track gold prices and where they could be potentially heading next, understanding the real driving forces like inflation, interest rates, and of course what the COT report is showing us, you need to make sure that you have the right tools. So take advantage of that trial that we mentioned earlier. And again, keep an eye on price action, but don't over focus on it. One of the biggest mistakes that I see new traders doing is they hyperfixate on technical analysis and they overlook or kind of ignore fundamental analysis, thinking that it's not as important as just studying price. But I can tell you that in my years of experience and becoming profitable in trading, fundamentals have played a far bigger role than trying to study just price action. Again, there's nothing wrong with price action, but obsessing over it is a very common pitfall that I see new traders making all the time. So grab a copy of the Edge Finder down below in the description. Yes, this is a sales pitch, but I want to always make sure that when I have a sales pitch for you, I call it out for what it is. It's a sales pitch, but it's rooted in true value and something that I've actually found profitability in my own trading journey. So try it out, see if it's the right tool for you, and thank you for watching. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.